Welcome back to Coffee with Krav. Great to see you all back there. Cheers to Coffee with Krav. Well, unless you've been hiding under a rock, you recognize that there's been tremendous amount of volatility and disruption in the stock and the bond market and the economy. And it almost feels like Dorothy in The Wizard of Oz going down that yellow brick road where she was going lions and tigers and bears, oh my. And in this case, it's inflation and higher interest rates and wars, oh my. Quantitative tightening and supply chain and COVID, oh my. So to get through this, it's going to take a good brain, a lot of courage, and a lot of heart. So today we have our own Wizard of Oz, Brian Nick. And Brian is actually the first person at Coffee with Krav that is a repeat customer. So welcome, Brian. Let me give your bio for those of you who don't remember Brian. Brian has over 16 years of experience analyzing economic and market data and developing investment strategies for clients' portfolios. As Chief Investment Strategist, Brian is a member of Nuveen's Global Investment Committee, where he works closely with the firm's investment leaders to identify investment trends and provide insights on events driving market activity. He's also a voting member of the Asset Allocation Committee of Nuveen's parent company, TIAA. Previously, Brian served as head of tactical asset allocation for UBS and as a senior investment strategist at Barclays Wealth. He began his career in the market group at the Federal Reserve Bank of New York. Brian graduated with a bachelor's degree in economics and government from Dartmouth College and a master's degree in economics from NYU, and holds the designation of Chartered Alternative Investment Analyst. Welcome back, Brian.
Thank you very much. Cheers. Thank you for having me back. I was concerned as you were going through that Wizard of Oz explanation that I was going to get introduced as the wizard, who, to the best of my recollection, wasn't actually a wizard, although he was well-intentioned and I guess was at least remotely helpful at the end of the day.
Well, he did come up with the slippers, right? So, you know, there was some magic in that. So we're going to get to the slippers. Maybe you'll give us some magic slippers to get us through this this situation. Well, actually, Brian, it's been almost 2 years since the last time that you were on Coffee with Krav. At the time, we were worried about COVID. We were in a recession. While there's some similarities, we still have COVID, we're close or so to recession. But in between, we've had a terrific rally in the market. We've had a new president. We have many concerns right now. And among them, and one of the biggest concerns is inflation. We have the highest inflation in the last 40 years. However, there's talk about peak inflation. Are we there yet? What's your thoughts on inflation?
Yeah, you know, inflation's a big problem when the president himself has an article or an op-ed that's just published in the Wall Street Journal. So he knows that it's on voters' minds, on people's minds, and obviously so do we as investors. This has been a huge, to an extent that really I haven't seen in my career. Nobody's really seen for 30 or 40 years, been a hugely influential factor for how markets have behaved, because we see it through so many prisms, right? There's the impact on the economy. There's the impact on what the Federal Reserve has to do with interest rates to respond to inflation. And that has its own sort of vector off into influencing market behavior. I would say we've had two distinct vintages of inflation. We had the 2021 vintage, which was really all about too much demand chasing too few goods. We gave people stimulus checks. We gave them the enhanced child tax credit. They got enhanced unemployment insurance. And we just created a lot of demand last year for goods and some services, but mostly for goods that we just simply couldn't produce enough of. I think supply chain issues and shortages get blamed for a lot of what we saw last year, but really supply was as strong as we've ever seen it. The world made and traded more stuff last year than it ever had before. But as consumers globally, we also bought more of that stuff than we ever had. And the gap between demand and supply was simply too large for a lot of companies to sustain. So we had shortages, and where companies had pricing power, we had higher prices. that vintage of inflation seems to be fading pretty quickly. If you've walked in to try to buy a TV lately, you know the TV prices are down, other electronics prices are down, things that there was a big splurge for during the pandemic and initially right after the stimulus was paid out last spring. Those things have really started to come down in terms of demand. And we know from the last couple of weeks, a lot of retailers are reporting, you know, larger and larger inventories of these things. They're not selling enough of them. So I would expect that certainly by the end of the year, but probably even over the summer, we're going to start to see more sales on more types of things. I know I'm getting more emails from Best Buy and companies like that, places I bought things from in the past, telling me that things are on sale. That wasn't really happening for most of the past 2 years. This year's version of inflation or vintage of inflation is much more broad. It's going to be more concerning to the Federal Reserve and to us as asset managers, which is wage price inflation. We're seeing prices of personal care. So if you've gotten a haircut recently or gotten your nails done, you've probably seen those prices rise. We have rental prices moving up. This is happening because the labor market is tight, arguably too tight. And this is the type of inflation that the Federal Reserve, can't ignore. It can't look at, energy prices. Oh, that's an external thing. That's the war, or that's something else going on, or the supply chain issues with goods prices last year, or the stimulus being a one-off. What we really are concerned about now is there's just too few workers to fill jobs, and the wages for those workers are going up. And that's going to result in higher prices as companies are forced to hike, right? So you've probably seen prices go up this year on a wider array of things, both services like maybe menu items, things you've eaten out in restaurants, you've seen higher prices, and on some goods as well, and certainly on the cost of living when it comes to rents or purchasing a home. So that seems to be the more concerning and now very present type of inflation that we're being hit with. And we see the Federal Reserve responding to it much more aggressively, and other central banks too around the world responding much more aggressively to the 2022
let me talk
inflation.
about the Fed. Let me talk about the Fed for a second, because I think that you brought it up twice now, and that's a very good point. The Fed looks like they were behind in their thinking. Last year, they were talking about, hey, inflation's not a problem, it's just transitory. Obviously, they were wrong, and perhaps they should have started increasing interest rates a little bit earlier. They're at only the beginning of increase of interest rates, and they talked about, or at least we hear that they're talking about, two increases of 50 basis points the next two times that they meet, June and July, and then a series of 25 basis points. Is that the route that you think they're going to do? Is that the right route? Is that going to help things, hurt things? What's your thoughts on that?
Yeah, I think the Federal Reserve doesn't want to deliver any more surprises. But really, the reason the first 3 or 4 months of the year were so unpleasant for investors is because the Federal Reserve was delivering a series of hawkish surprises. In other words, they had to continuously get pulled in the direction of, we're going to have to do more about inflation. We're going to have to raise interest rates by more. And coming into the year, we thought there was a chance the Fed wasn't going to have to raise rates at all because of the transitory inflation story. And if it was just the goods prices, then I think we would still be in that scenario. But now we've had the energy shock, which has ripple effects to other prices of goods and services. And we have the very, very tight labor market, which is much stronger this year than we or the Fed expected. So now the Federal Reserve has been pulled in this tighter direction. We're not talking about how many rate hikes anymore. To your point, we're talking about whether it's going to be 50 or 75 basis points, which is not something the Fed's had to do since the 1990s. And they've already done one 50 basis point rate increase. They're almost certainly going to do two more, one in June and one in July. And then September is basically 50-50. And then, as you said, the other months this year are basically seen as 25. So the Fed's going to have to really kind of ratchet up, maybe pull forward the tightening path that it needs to go on. It wants to do as much to fight inflation in the near term as possible, and then be able to kind of slow down and maybe wait to assess what kind of an impact that's had on the economy. The Fed's going to have to see a couple of things. They want to see fewer job openings per unemployed worker. Ideally, they'd like to destroy job openings, but not destroy occupied jobs. So we don't want to see the number of unemployed people go up, but we would like to see on the margin companies be less likely, less willing to hire more workers. And that would bring the supply and demand of the labor market back into balance and not put as much upward pressure on wages, which is really, that's the key. I mean, the wage price spiral that's the thing that every central bank wants to avoid. And the longer we're sitting at 3.5% unemployment with over 11 million open jobs, the harder it's going to be for the Fed to forestall that. So what we're concerned about is, if that doesn't look like it's happening, then the Fed's going to have to surprise the markets again and again with more and more interest rate hikes. And we could be in a situation where we're not talking about the Fed getting to 2.5 or 3% on its policy rate. We're talking about 3.5, 4, or 5%. And that's been I think that's the sort of the tail risk scenario where we almost have to have a recession at the end of that, because we just don't have any scenarios where that amount of interest rate tightening goes on and we don't end up in a much slower growth environment. But what the last couple of weeks, we've had somewhat better news on that front. We've gotten some indications that maybe the economy has already slowed a bit, so the Fed is doing its job, and that inflation is not going to be a persistently higher thing, that maybe we saw the peak in March and it started to come back down. Now, that's not comforting to anybody who's still filling up their gas tank on a weekly basis. Those prices are still going higher, but the Federal Reserve is looking at a broader array of things. And as long as the labor market looks like it's taking a step or two back, the Fed's probably going to be satisfied with around what's priced in, which is the Fed slowly gets to about 3% on its policy rate, and then it's able to kind of stay there.
Okay, and you also mentioned supply chain. You know, what's your thoughts on China's strategy of the zero COVID, and the fact that the supply chain issues helped this higher inflation? It looks like they're starting to open. I know that there's talk this morning on CNBC about them opening up even more. What's your thoughts on supply chain? What's your thoughts on China? Having that issue that has helped hurt us with the supply chain.
Yeah, certainly not welcome news. I mean, we've gotten sort of bad news piled on top of bad news, and these things aren't necessarily related, right? The tightness in the U.S. labor market is not really related to the supply chain issues caused by China, which is also not really related to the war in Ukraine and what's that done to energy prices. We see the same things, indications that with China sort of past peak COVID, and therefore we're going to see some of these important manufacturing and transport hubs reopen. But we also saw something else during this period, during this sort of closed lockdown spring in China, that's interesting and has implications for the global economy, which is China prioritized economic activity during these lockdowns. It didn't just shut everything down and say nobody can leave their houses. That's sort of what gets reported out. But manufacturing was still ongoing. Trade was still ongoing. The areas of the economy where China really deprioritized was domestic consumption and imports. So if you look at the average sort of Chinese port, China sort of, they kind of know what still kind of keeps that economy running, which is manufacturing and shipping goods to the rest of the world. And that part, was certainly interrupted, but not to the same extent that China's domestic economy was, because they were keeping factories open. Manufacturing year on year remained positive during this period. Imports went to zero and dipped into negative territory, but export growth has not. So this is not, January, February, March of 2020, where China really just sort of stopped everything. It's a dire economic scenario in China, but for China's export partners, it has not been quite as punishing, because it has really found a way to keep its sort of external facing economic output going at the expense of its internal economic model. So China's economic numbers over the next couple of months are going to look terrible. They already do, but we haven't seen the same degree of supply chain disruption that we might have expected just from reading kind of what the policy has been, and kind of going back to 2020 and remembering what happened there. So, knock on wood, things are reopening again, and we should be seeing everything start to function more normally, but we haven't seen as much of a disruption. And part of that is that American consumers, European consumers are just buying less of the type of stuff that China makes today than they were over the last 2 years. Because if you look at electronics, other types of goods, we bought a lot of that stuff last year. And a lot of it are things that you don't necessarily need to buy every single year. So the way the economy is rotating from goods to services also makes us less exposed to whatever economic disruptions might be happening in China.
Okay, excellent. Just a quick question on that. Do you think that there's going to be more of countries bringing things closer to home, manufacturing closer to home, either in home or the neighboring people, as opposed to utilizing China as much? Do you think that there's going to be a long-term lingering effect? And if so, is that inflationary?
It potentially is, if it's sort of done as a top-down thing. So if a country is mandated that you're no longer allowed to outsource and everything has to be made in-house and there's no more global supply chains, that would be hugely inflationary for a number of manufactured goods. If it's companies doing it sort of out of self-interest, where they perceive that, hey, we can do things more efficiently. A lot of the localization, I don't know if I call it de-globalization quite, but there's still a lot of globalization, but localization of some types of manufacturing processes, some types of businesses makes sense because consumers are demanding things delivered in faster and faster time frames. So if the biggest sort of lag in your time from order to delivery is just the distance you have to cover and the complexity of getting things around the world and worrying about inventories, then it makes sense to localize things more in terms of the production process. So you could see some things like that happen. The bigger outflow from China in terms of business is really just around other countries. So remember back before COVID, I know it's hard to remember, but 2018, 2019, the big economic story in the world was the trade war between the US and China. And that resulted in a lot of manufacturing being taken out of China, but not necessarily being brought to the US, but more the beneficiaries of that were Mexico and to an even larger degree as a percentage of its economy, Vietnam. So we're not pulling back entirely from global trade and manufacturing and complicated supply chain routes, but we are doing less of that business in China. China only accounts for about 20% of what gets exported to the US from around the world. And we obviously do a lot of importing, and 20% of what we import is still a lot of money and a lot of goods, but it's not, I think most people would say we get everything from China, or a lot of people might be under that impression, but it's actually not true. And China's actually been shrinking as a percentage of total US trade.
And that 20% is down from, do you know what it's down from?
I think it was closer to 25 or maybe even, pushing on a third. But obviously what happened in 2018 and 2019 was the trade deficit didn't shrink between the two countries, but the amount of trade done between the two countries did shrink. We didn't catch up in terms of what we were selling to them.
Let me move over to the war that's presently going on. Obviously, gas prices are surging now. What's your thoughts on the war and the effects that it has on our economy and the economy globally?
Well, the two things that have surprised us the most since this started, and we're not going all the way back to mid-February when this sort of became a reality. Even before that, you were seeing commodity prices increase on the expectations that there was just more risk being priced in that this would happen. It's just gone on a lot longer than I think anybody would have expected. And the commitment from Ukraine's sort of allies or Europe plus Japan plus the US to basically boycott Russia, to almost kind of cancel Russia as an economic entity in the world. It's been pulled out of these different indexes. It's not in the bond indexes or the stock indexes anymore. The commitment to do that, and now even the news that we're getting right now about Europe trying to do its best to be completely off of Russian crude oil. I mean, these are significant economic changes that the more kind of permanent they become has implications for just the balance we're going to see in the energy market. So there's two main things that I think we're going to continue to see. One is absent some kind of extra bit of supply from somewhere in the world, the fact that Russia's production has gone down so much because they have so many fewer partners willing to buy their crude oil and natural gas, that's made prices go up for everybody, even though the US wasn't importing a particularly large amount of Russian oil, certainly not any Russian gas. It's a globally traded commodity, so all these things are moving up in price, and the price increases have persisted. They haven't kind of melted back down as some kind of ceasefire is negotiated and we can ease sanctions. The longer this goes on, the less likely that looks. And now you have a lot of these commodities futures markets that were pricing in, figuring the price is going to go back down $80, $90 a barrel. That's not really the case anymore, certainly not this year. So this higher for longer mentality is staying with us. And I think the other coming time bomb is Ukraine is simply not exporting and Russia is not exporting as much food or things that are used to make food to especially poorer countries or emerging market countries that were buying a lot of stuff from that area of the world. And that's going to lead to a global food crisis. That's maybe not going to hit us here in the US, except maybe with some higher prices, but it's sort of a dire, not just an economic scenario, but sort of a humanitarian scenario in a lot of countries. And that's something I think we're not even really kind of fully seeing or pricing in yet because of the way the harvest seasons work. So the fact that this has gone on as long as it has, and the commitment to not paying Russia anything for any of its exports, both of those have been surprising and have had much more lasting effects. And obviously, as you see it with inflation, the Eurozone inflation number continues to move up because a larger portion of what European consumers buy is energy related than it is here in the US. So their inflation rate is much more sensitive to changes in energy price than even ours is. And we know what happened to ours in March when the oil prices were up 20 or 30%.
You mentioned about the food. Are there any countries that can pick up the slack?
Yeah, the United States is one. It's not always easy to respond to quickly, right? Because you have to worry about when you're planting and what you're planting and where the shortages are going to be. So growing, agricultural commodities for kind of mass sale is always a tricky thing because you don't want to be wrong on supply and because of weather or because if there's something else happening in the world. But there's a reason that food prices don't just inexorably go up over time. It's because we're able to increase supply, we're able to produce and grow food more efficiently. In the near term is much more where I'm concerned about. There are places in the world in Eastern Europe that are away from the theater, or Australia or Brazil or the United States where a lot of this food can be grown. But it's the next 6 to 9 months that are the most concerning because that's the hardest to kind of, change up on the fly what you're growing and where you're shipping it to.
Wow. Okay. Well, thanks. Thanks for that. I'm going to be flip-flopping around to different topics. Historically, gold has been a great storage of value. Last year, there was talk that Bitcoin could replace gold as a great storage of value. Now, Bitcoin is down, 55% from its highs from November. Doesn't seem like it's stored value all that great. Just wanted to get your thoughts on gold and maybe a quick thought on Bitcoin.
Yeah, I mean, there's been a lot of beating up on Bitcoin. I think it's a lot of it's fair, but obviously there are a lot of things that are down significantly from the peak last November. A lot of technology stocks are underperforming Bitcoin. I think both of these assets fall into a category that we often see whenever there's a rise in interest rates and maybe a simultaneous concern about economic growth. And that's that neither one of them are spitting off a yield. So when interest rates start to go up, the attractiveness of just keeping money in your savings account or putting it in what you thought a couple of months ago was a low yielding bond that maybe isn't so low yielding anymore because rates have gone up a lot. The opportunity cost of being in something that's basically inert and not producing anything for you is significant. And then there's a question of valuation too. Both of these assets are very hard to value, to assign an intrinsic value to. It's almost worth whatever the next person is willing to pay you for it. And whenever you have a time where it looks like prospects for economic growth are slowing down, there's always concerns about any kind of asset that may be called sort of speculative in terms of how it's priced. So not surprised to see Bitcoin struggling in the context of rising interest rates and concerns about growth. I also maybe throw in that there's also this other collection of asset classes that benefited in some way from the pandemic. There's certain companies that sold products that suddenly became much more useful during the pandemic. Exercise bikes and Zoom did very well when all of a sudden everybody needed to use and own these things. But I would say when people were sort of locked up or locked down or felt like they really weren't able to go out and do things, people spent money in different ways, and there was a lot of financial market speculation, especially when there were stimulus checks being handed out, and if you really couldn't use that check to take a vacation or to go out for a nice dinner or just to get together with people, a lot of folks use that to speculate on individual stocks, these new kinds of trades, things like NFTs, Bitcoin, and again, whenever that time passes, when it looks like now people are behaving much more the way they did before COVID, any beneficiary from that trade is going to start to look like it's going away. And if there are things that look like they've been mispriced or overpriced, they're going to tend to get hit the hardest. So I think there's two things. There's the usual what happens when rates go up trade that I think both gold and Bitcoin are suffering from. And then there's the very specific COVID trades that Bitcoin is also.
Well, I wouldn't equate gold and Bitcoin the same way. I mean, gold is from November, gold is probably slightly up a little bit, and Bitcoin's down 55%. So, if you're an investor and you're doing a diversified portfolio and you're looking for an investment that is going to store value, that's what I was asking was, a 55% loss, there's no storage of value there.
Right.
If gold had the same reaction, then I would say, yeah, they're equate. But gold really didn't have the same reaction. Gold was either flatline or even up, especially during this market disruption that we saw, especially this year. Whereas Bitcoin's gone down. Bitcoin seems like it's acting to what you're saying, acting a little bit more like a technology stock. Yeah. Because of the rising interest rates versus gold acting a little bit more like a storage of value.
Gold has done better than I would have expected, given that we had this large increase in interest rates. And I think as long as there's some lingering doubts about whether the Fed has actually licked inflation, right, there's going to be more demand for gold, because there's a very limited collection of asset classes that you think are going to do better in a sort of a higher inflation environment, even if growth looks like it's not going to be quite as robust, and gold sort of fits that, maybe that kind of 2x2 matrix better than most things.
Okay, let's talk about the stock market. Hey, it was up over 6% last week. I guess this bear market's over, right? Well, what's your thoughts on that?
We came so close to a bear. I mean, we actually did dip. For those who don't know, bear market is a 20% top to bottom correction, usually only associated with recessions. We really only had one bear market that wasn't a recession. It was the crash in 1987. We came very close to one in 2018. It was 19.8% top to bottom. We got almost that down that far just a few weeks ago now. Right. But there was a bounce at the end of the day on Friday, and then, as you said, last week we were kind of off to the races. Yeah, look, we had a negative growth quarter in the first quarter. I don't think we're going to have one in the second quarter. So I don't think we're currently in recession. But there certainly is the risk, as interest rates continue to move up, that we get closer to a slower growth environment where not as much needs to go wrong in order to dip us into recession. Think about Europe after the global financial crisis. They were dipping in and out of recession constantly because their growth rate at 1%, you don't need a whole lot to go wrong to have a few negative quarters in a row. Same thing with Japan. In the US, we need a bit more to go wrong because our potential growth rate is maybe 2.5%. But in a rising interest rate environment where investors are taking less risk, companies aren't hiring, consumers may eventually start to slow their spending down. There is that risk. Now, the bear market, as I said, last week, I think a lot of that was about if the risk of the Fed taking us to 12% interest rates to have to fight inflation, if that risk seems to be going back down, the market is going to be able to price that in. And I think what we saw was a little bit of our pricing out of the worst case scenario for the stock market over the last week. We saw pricing for Fed funds kind of futures. What's the Fed going to do in the future? Those rates have come down. Interest rates across the board came down last week, whether you're talking about the 2-year or the 10-year. So all kinds of mostly positive things happening as the economy seems like it's slowing down just enough, but maybe not too much. Now, in terms of what that means for the stock market, look, earnings have now had many good quarters in a row. We know that the growth rate is going to slow down from last year because 2021 was the easiest year to compare, to 2020 was terrible. The growth rate in 2021 was maybe 55%. This year, it could be more like 7, 8, 9, maybe 10 or even 15% if we have a very.
What about valuations? You're looking at 16.5 times forward earnings. Is that the right valuation? Should we be lower than that? What is kind of fair value there?
So the context is we come down from 22 or 23, and now we're at if you look back far enough, would look like an average valuation for the S&P 500. And that doesn't mean a recessionary valuation, because when you're in a recession, you can get down to 14, 13, 12, 10 even in a really bad one. So I'd say that recession is not priced into the equity market. We've had what I think we can still call a bull market correction here, a particularly nasty one, given that it's related to the Fed and the outlook for interest rates. But I don't think we're going back to those really lofty valuations that were really supported by very, very low interest rates and the prospect that they were going to stay low maybe forever. Now that we know that that's not going to happen, you have to look at the valuation between stocks and bonds to get maybe a bit more of a balance here. Right now, they look pretty balanced. We have, a 10-year that's around 3%, maybe a little lower. And we've got a stock market that looks like it's valued around average. So I think we're priced for a normalization of the economy post-COVID. And if things look like they're going to get worse and we're headed for recession, I think the stock market's going to have further to fall. I would point out, though, that as valuations have fallen this year, one of the things that's driving that certainly is the decline in the prices of the stocks. But the other thing that's helping that along is increases in earnings expectations. So analysts looking at individual companies or at the whole market are still not seeing the type of weakness that we would expect to come with a recession in terms of the impact on earnings. And that, I think, there's two ways to look at that. One is to be optimistic that, look, these individual companies are not
Well, they could be
giving
wrong.
recessionary guidance, or the analysts could just be wrong,
Right.
and we have
right.
a lot further to go.
An analyst wrong? That never happens.
Can't remember that.
So value has outperformed growth this year. Do you think that trend will continue, or is growth so beat up or soon to be so beat up that it can start look interesting again?
When I think of a normalizing or a more normal economy for the US, I think of growth outperforming. That's just sort of what we've seen over the last 10, 15, 20 years. A really abnormal economy where you have parts of sort of these higher growth, higher valued assets getting clobbered because people are reassessing their outlook for interest rates in the economy. Plus, there's this huge energy spike going on. I mean, the weirdness of the economy in the first 4 or 5 months of this year, I think that is what's been driving the value outperformance. So I certainly wouldn't look at another comparable magnitude outperformance of value versus growth, because so much of it has been energy related. I think as it seems like we're sliding into maybe a more normal, maybe slightly below normal growth environment, as growth becomes a bit more scarce in the economy, I think that tends to be a time when growth stocks outperform. You think of anything that becomes more scarce, the price of anything you can find tends to get bid up. So I would think, are we as beaten up as we're going to get for technology stocks, or higher valued, more kind of speculative consumer stocks? Perhaps not, if we get more kind of bad economic news in the near term. But if we get out of this without a really nasty recession, I think there is going to be a time when growth gets the benefit of the rotation in the dollars again.
And you mentioned before that last year we bought a whole bunch of goods, right? And now that things are kind of open up, we're kind of going to services. So instead of getting all those packages outside your apartment or your house, now people are going to spend on experiences or travel or leisure. Do you see that as a trend, and will that trend continue?
Absolutely. And we're not actually as far along in that kind of rotation back as you'd think. We got these numbers last week that surprised me, that durable goods spending in April was still extremely strong. And even the areas of the economy where prices are falling, we're continuing to see people buying more and more stuff. So Americans have not yet stopped buying stuff. They are buying more experiences, going out and having more fun. You can see this a little bit in the stock market. You look at a stock like Delta that's basically flat year to date, when compared to the whole market being down 18, 19%. So there is an outperformance there as airlines, as other kind of travel, leisure related areas that start to do better. Now, a lot of those companies are having issues hiring people, and they may have to eventually, if they haven't already, raise prices. We had a huge increase in airfares in the month of April in the inflation report. That's not just because of jet fuel, it's because a lot more people are getting on planes and want to book travel for the summer. So the rotation out of goods into services is certainly already happening. We've seen it in the last 6 or 9 months. It hasn't been as powerful initially as I would have expected. I think that just means it's going to be a much longer process.
Okay, and just to talk about housing for a second, housing has been white hot, and it's now turned maybe a little less to red hot. Just general thoughts about housing at this moment in time, especially with rates moving up.
Yeah, a lot of concerns about housing. This does not look like 2006 or 7. There's no inventory, right? So what you don't want is a huge drop in demand with a huge existing inventory of homes to be sold. That's a recipe for a 20 or 30% decline in home prices. What we have now is declining demand because of higher prices. And also because of higher interest rates. So borrowing costs have helped price people out of some areas of the market. But we also have extremely tight housing inventory, and while we're building a lot of homes, we're not building enough to keep up with demand. Some of that is demographic. You have millennials now that are basically aging into home ownership, so there's more demand for single family homes. There's also just more demand for space. COVID has also warped this market. So if maybe the homes aren't in the right places, or they're not big enough, or they don't have a big enough yard, because now people feel like they can do some of their work from home. So the more you're going to be home, the more you care about how big your house is, how many amenities you have, and all of these things impact the housing market. This is a necessary condition for the Fed. If you look at the things that it needs to see before it stops raising interest rates, it needs to see that housing market cool off. What's been fascinating is if you've seen these new home sales numbers come down, which is, again, a sign that the market is becoming a little bit less frothy, less white hot. The average home price is continuing to go up. So you have some folks that are priced out, but the folks that aren't priced out, that are maybe more price agnostic, they're continuing to bid up the prices of the existing homes. So what you're probably going to be seeing is a smaller overall number of transactions happening, but maybe happening at a higher price point where the mortgage rate and the actual price of the home doesn't matter as much for the people who are still buying. And that, I don't know, that from an economic standpoint, that means not as many people are going to be moving into new homes. There's not going to be as much buying activity that we know comes out of moving into a new home in terms of furniture and decorations and everything that goes into it. But that part of the economy was too hot relative to what's being supplied. And everywhere in the economy where demand is too high and supply is too low is an area that the Fed either directly or indirectly would like to see brought back into balance. And so what we're seeing is shouldn't be surprising, and it shouldn't be overly concerning.
Okay, thanks. And just to go over to the bond market, we've been in a bull bond market with interest rates coming down for decades now. And then now we've seen a U-turn and rates are going up. And this year bonds were down double digits. And generally when you see a big disruption in the stock market, at least you have the bond market that you can rely on, and that can work. But if you have double-digit losses in the stock market, double-digit losses in the bond market, there's almost nowhere to hide. So just what's your thoughts on the bond market at this level?
Yeah, so if you've only been an investor since maybe the early 1990s, you really, to your point, haven't seen anything like this, where you have steep losses on the bond and the equity market at the same time, because to your point, they're usually negatively correlated. If you go back to late 1950s, 60s, 70s, 80s, the relationship between stocks and bonds was different because a lot of the bond market trading was happening off of inflation concerns. And once inflation was basically licked by the early 1990s, and we really didn't have high inflation after that, the bond market would trade off of growth. So when interest rates were rising, it was because growth prospects were improving, which was helping the stock market. And that's what helped build in a natural negative correlation that helped so many investors over the last 20 or 30 years. We've seen that this momentary return, I think, to, well, if everything is priced off of inflation and interest rates are going up really quickly, that's not good for the stock market, and we know it's not good for the bond market. The last couple of weeks, I don't want to, again, jinx anything, but it seems like the fact that the economy is clearly slowing down, the market's attention is turning more towards growth concerns and away a bit from inflation concerns. And we've seen on the vast majority of days in the last couple of weeks, the bond market and stock market move in opposite direction. So if the 10-year treasury happens to be up on a given day, it means that the stock market is probably up also. Now, you have some days where inflation creeps back in. You get a big inflation print from Europe. You get some news that Europeans are not going to buy as much Russian oil. And all of a sudden that snaps back in and we get concerned about the Fed tightening things up again. What I would say is, again, as we're kind of struggling, scratching and crawling to get back to a normal economy, I do think the relationship that held for the 90s, 2000s, 2010s will reassert itself. And the reason for that is the big downward driver of interest rates over the last 30 or 40 years is still with us. It's demographics. We have an aging population. We have more obligations to the population that's aging into retirement. We have fewer people working to support the rest of the population. And despite the fact that means probably more borrowing and higher borrowing costs, it will tend to drag down economic growth. It will tend to drag down overall economic output, productivity. And that has been the major thing pulling down interest rates in places like Japan, in Europe, and the United States. So we haven't reversed that. We're not going to reverse it for another couple of decades. And so I think that will reassert itself. And the idea of interest rates rising being a bad thing for the stock market, I think, can go away pretty quickly once we're past this period of higher inflation.
So if you had to put a percentage from 0 to 100%, that we're going to go into recession either this or next year, what's your percentage that you would give it?
So I'd be a little higher than I normally would be. I normally, if you just asked me to drop me at any place in time, I'd probably say 20 to 25% in the next 18 months. I'd probably be more like 35% for the next, if we're going 18 months out into 2023, which I think still qualifies me as an optimist on this question.
Okay. And if we did go into a recession, and correct me if I'm wrong here, we're not looking at a great recession like we saw 2007 to 2009. This would be, I guess, more a garden variety type of recession.
Yeah, we haven't had a garden variety recession for I think since the early 90s, right? Everything since then has been some kind of major financial collapse or a pandemic, right? So nobody's really seen this, right? In not wide living memory, but most investors don't remember a normal recession. We could have a recession with the unemployment rate going from where it is now, 3.5% to 5%. That would easily qualify as a recession under most kind of historical comparisons. And again, nobody really think of 5% unemployment as being high. But it obviously would be painful for the people who have lost jobs or who have less job security as a result. But we're not talking about the unemployment rate going to 10, 15, 20% like it was for a very brief period during COVID. We're starting from really solid ground here. We have really solid balance sheets with a lot of people still have a lot of savings that they're quickly spending down, but not so quickly that they're going to have no savings left. And consumers, despite what they say in confidence surveys, are behaving very confidently. So there's this sort of sense right now that people will tell you the economy stinks, but it's okay for themselves. And if everybody thinks that, you might not get quite the amount of robust spending that you would otherwise, but people spend more according to what they feel like their own situation is compared to what they feel like society or the country in general might be going through.
Okay, and lastly, we have a midterm elections coming up, which normally causes its own disruption. However, do you think that it'll be disruptive, or maybe this time it can help the markets?
I think we're probably looking at sort of a net zero impact, right? For two reasons. One, it's been so clear for so long what's going to happen in this election, between the redistricting and the census changes, but also just the wave of public sentiment against the Democrats right now, who have the majority in both houses. There's almost no chance that there won't be a Republican House, and the Senate maybe is closer to 50-50, but it doesn't matter that much. All you need is one house that isn't on the president's side, and then very little gets done. So I think divided government is not a deal breaker for markets, not only a bad thing for the stock market. It can lead to more dysfunction, as we've seen in recent years. We had that, the last time we had a Republican House and a Democratic president, we had the debt ceiling debacle in 2011. We had a lot of government shutdowns. We've had government shutdowns with the opposite too, with a Democratic House and a Republican president. It probably just means not a whole lot gets done, but I don't think we're going to come to a point one day as we approach the election where the markets start behaving in a different way because of that expected outcome, because that outcome has already been, all but kind of sealed. So there's a combination of divided government is sort of, shrug of the shoulders for markets, and also when the outcome is clear, you don't tend to see big surprises around election day.
Okay. Any parting comments or thoughts?
Just that obviously, we talked about the stock and bond markets being sort of similarly negatively correlated this year, or both down year to date. We do think things are going to get better. When we talk about investing and we go across our different asset class areas, we're adding risk almost everywhere. Our fixed income people feel good about how the bond markets are priced, credit markets, municipal markets, we're turning much more bullish now because of that sell-off in that market. And in the equity markets, we're basically not holding on to cash. We want to be in some of these areas that got beat up, and we still think that stories like energy and banks, which have done better, can outperform. So we're still optimists, both on the economy but also on the market opportunity, especially for investors whose time horizon extends further than, say, the end of this year.
Well, I'll leave you with that optimistic outlook. I appreciate that. Our own Wizard of Oz here, who gives us an optimistic opportunity. So again, we need to have a good brain. We need to stay with some great courage, and you have to have a lot of heart, and we'll all get through this together. So thank you again. everyone, for joining me with Coffee with Krav. Brian, thank you very much. You said it all there. And until next time, be safe, and we'll see you soon. Thank you.
Thank you.